Hello, good evening. Thank you for joining us today. We'll start shortly at about 7:05 p.m., so you can make yourself comfortable. So feel free to submit if you have any questions via the Q&A box at any time, and we will address them during the Q&A session. Hey, good evening, everyone, and welcome to our webinar. So we are thrilled to have you with us today as we explore an exciting new opportunity in the world of investing. So it's the Lion China Merchants Emerging Asia Select Index, EDF. So we are honored to have with us today Mr. Ong Xun Xiang, ETF Business Lead at Lion Global Investors, to share with us valuable insights into the growth potential of the IMIT economies, as well as diving into the details of the ETFs, its objectives, key features, and how it aligns with the growing demand for exposure to the Asia emerging markets. So thank you for joining us again, and without further ado, let's get started.
Okay. Hey, good evening, everyone. Thank you, Cindy, for the introduction. Okay, before I start officially, let me share screen. All right. Okay. Okay. Cindy, can I confirm you can see my screen?
Yep.
Okay, great. Okay. Good evening, everyone. Thank you, Cindy, for the introduction, and thank you to the Tiger Brokers team for inviting me here today. I'm Xun Xiang from Lion Global Investors. If you find my name too difficult to pronounce or remember, you can just think of me as the ETF guy for Lion Global Investors. So today I'm here to share with all of you about the Lion China Merchants Emerging Asia Select Index ETF. So for the entire presentation, actually I just have two key messages I want all of you to remember. The first key message would be this is the world's first emerging Asia ETF that is traded in Singapore dollars. So the world's first emerging Asia ETF traded in Singapore dollars. And the second point would be this ETF's SGX ticker. It will be EAA. So you can simply remember it as Emerging Asia. EAA. So I hope this will be easy for you to remember. And before I dive deep into the ETF, let me maybe briefly introduce how this ETF came about. So this ETF is a collaboration between Lion Global Investors and also China Merchants Fund Management. They are one of so China Merchants Fund Management is one of the leading asset managers within China. They are part of the China Merchants Group. So there's also the China Merchants Bank inside. They also have a private bank, which is China Merchants Bank Wealth Management, and they also have a securities brokerage arm, which is China Merchant Securities. So this securities brokerage arm will be the market maker also for this ETF after its listing. And maybe I'll give also a brief introduction about LGI. We are a Singapore incorporated asset management company. We are one of Southeast Asia's leading asset management firms today. We're part of OCBC Group, and today we manage up to 71 billion Sing dollars of assets for our clients. So we started our ETF journey back in 2017 when we launched our first ETF, which is the Lion Philippe S-REIT ETF. So today is one of the largest REIT ETFs on the SGX. And we actually, I would say, exponentially scaled this business during the COVID pandemic during 2020 to 2022, when we launched 3 ETFs within 18 months. So 3 ETFs within 18 months. So they include the Hang Seng Tech ETF, our China Leaders ETF, and also the Singapore Low Carbon ETF. And if you apply the cutoff as of the end of 2023, you'll notice that actually 3 out of our 4 ETFs back then were the top returning ETFs in their respective segments on the SGX. So for example, our SREIT ETF back then was in 2023 whole year, it achieved the top returns among REIT ETFs. For our Hang Seng Tech ETF, we achieved the top returns among China equities ETFs on the SGX in year 2023. And for our Singapore Low Carbon ETF, it also achieved top returns among Singapore equities ETFs on the SGX in year 2023. And fun fact for this ETF, it has outperformed the Straits Times Index since its inception. It's outperformed STI in 2023 and also 2024 year to date. And fast forward to this year, we already launched 2 ETFs within the SGX ecosystem. So this year, we are actually the most active and most vibrant ETF issuer so far. This is our 3rd ETF listing for the year. So our first ETF listing for the year was the Japan Active ETF. This was Singapore's first active ETF. And later, in May, we launched the APAC Financials Dividend Plus ETF. So this was the world's first APAC Financials ETF, which we listed. So with the upcoming ETF, which is this ETF we have with the Lion China Merchants Emerging Asia Select Index ETF, is our 7th ETF and also our 3rd ETF listing for the year. So all these actually, up with this listing, will make us the ETF issuer on SGX with the most number of ETFs this year, and also for the entire ecosystem. So based on SGX data, based on info as of the end of October, our ETFs rank within the top 10 ETFs held by retail investors like everyone, including myself. And also, if we compare and dive into this segment of SRS investors, our ETFs also rank within the top 10 held by these group of investors. And we rank by trading turnover in the whole year of 2023. Our ETFs also rank within the top 10. So 2024 year to date, our ETFs are also still among the top 10. In fact, our S-REIT ETF already increased in terms of trading turnover. And all these are because we are a Singapore incorporated ETF issuer. We are headquartered within Singapore. We are Singapore Inc. So because of this, we design and also build our investment solutions for the Singapore investor in mind. And this is precisely why we work together with China Merchants Fund Management to launch this Emerging Asia ETF, because we believe there's potential demand from both Singapore investors together with mainland Chinese investors on this product that is partly inspired by the Asian Tigers 1.0. So Asian Tigers 1.0 actually was an economic miracle that happened back in the previous century from 1960s to 1990s. So Singapore actually was one of these Asian tigers together with Hong Kong, Taiwan, and also Korea. And during this phenomenal moment, which Singapore was part of, the Asian tigers experienced a lot of growth, and fundamentally they were driven by 2 key factors, which you will hear me talk a lot about in the upcoming slides. First, it will be on foreign direct investments. And the second will be on competitive exports. And in the broader front, among the world's top 40 economies by GDP right now, only 16 of them come from Asia. So because of this, there's a lot of new opportunities that Asian economies can explore as the companies and corporates worldwide diversify their manufacturing and production bases and embark on this global trend of trade diversification. So this global trend of trade diversification will be able to help benefit a lot more Asian economies. So with support from favorable labor costs together with business-friendly environments, for example, like tax incentives, we notice and believe 4 countries, which are India, Malaysia, Indonesia, and Thailand, these 4 countries, we believe they are favorably positioned to attract huge foreign direct investments. So all these are what was the recipe that grew actually Asian Tigers 1.0. And we believe they are now reappearing and repeating within these 4 countries, which I will term them as IMIT: India, Malaysia, Indonesia, and Thailand. And in terms of the broader front, Goldman Sachs Research also expects emerging market share of global market cap to double from 27% to around 55% within the next 50 years. In 2050, which is around 20 plus years time, the world's 5 largest economies will surely include India and also Indonesia. And within 2075, which is a few decades later, India is also expected to overtake the US and become the world's 2nd largest economy. So all these are demonstrating how the Asian Tigers 2.0 are renewing the Asian economic landscape together with the global economy. So I'll touch on 4 countries: India, Malaysia, Indonesia, and Thailand. These countries one by one for a closer deep dive. So I'll start with the first country, which is India, which reminds us actually of a deja vu of China around 20 years ago. So 20 years ago, China actually had the world's largest population. At 1.3 billion, they had the world's largest working age population. And during that period, actually China experienced a golden decade for around more than 10 years, where it's actually doubled its GDP significantly. So because of this, China experienced huge growth during that period, undeterred by a lot of different tailwinds and actually further growing its economy. And if we fast forward to today, which is now, India has overtaken China in terms of the total population. Right now, its population is at 1.45 billion. So it is the world's largest population, together with the world's largest working age population. So all these makes us more inclined to believe that Indonesia is favorably positioned for growth, like China around 20 years ago, where it experienced a golden decade. So we believe India is also at the start of this golden decade that's about to unfold and unravel. And for India, in terms of the past 3 years, especially the average GDP growth rate and average GDP per capita growth rate has already reached more than 7%. They have overtaken China, which is now the 2nd largest economy. And being supported by the world's largest population, together with a rising economy that is straddling between the US-China tensions, amidst of this global trend of trade diversification, we expect India to attract a lot more foreign direct investment, especially into its manufacturing sector. So because of this, actually, there are a lot of tailwinds that are happening for India. And all these factors that actually drive foreign direct investments actually grew China and grew the Asian Tigers 1.0 back in the past few decades. And right now we are noticing them growing India. And within India, the economic growth rate is also much reflected within the stock market. So on the broader front, they are expected to show the largest increase in global market cap share from 2.5% in 2022 to around 12%, which is around a 4 times increase in the next few decades. And within the past 6 years, 5 to 6 years, we have noticed India also cumulatively outperforming the 4 Asian tigers, which includes Singapore, Korea, and also Hong Kong. So all these growth between the economy, between the stock market is reinforcing a virtuous cycle that is anchoring and supporting India's growth momentum. So I've covered the first country, which is about India. The second country will be about Indonesia. So Indonesia, some key facts. They are ASEAN's largest economy, ASEAN's largest country, and also the world's largest producer of nickel. And another fun fact is that it is actually one of the few countries in the world that enjoys a trade surplus with China, which has reached more than $9 billion in 2023, even when commodity prices were actually weak. So if one day commodity prices were to slowly rebound, all these trade surplus could actually further increase together with China. So Indonesia is a country with a lot of natural resources, and it also went through a transformational period during the Jokowi era for the past 10 years. And we believe Indonesia is well positioned to double its GDP from 2022 to 2032 because there are a lot of tailwinds that are driving Indonesia. And one key change that has happened within the Indonesian economy would be its mineral downstreaming strategy. Actually, this started with a ban in 2020 on nickel ore exports. So because of keeping more nickel ores itself, all these actually started a focus on producing higher value nickel items. So they include EV batteries, stainless steel, and actually created an investment cycle. So more and more Chinese companies, corporates, manufacturers, especially like EV car makers, actually started growing and investing within the nickel producers and all this helped to grow the trade surplus of Indonesia with China. And within this field of nickel production, Indonesian producers have a competitive advantage through lower operating costs and also at the same time lower cost of financing from the Chinese companies that are invested within Indonesia. So in 2023, which was last year, Indonesia produced around 40% of the world's total nickel. So this advantage and also total production is expected to increase to 44% of the world's total nickel within the next 4 years. And lastly, in terms of GDP growth rate, for the past 10 years, they have overtaken Singapore, overtaken Korea, and also Hong Kong. So these three were the previous Asian tigers. And same thing happened, and same trend happened also for the GDP per capita. So for Indonesia, being supported by Southeast Asia's largest population, together with growing exports that are competitive, for example, like nickel, all these are expected to help Indonesia double its GDP from 2022 to 2032. So earlier in the slides, I mentioned that foreign direct investments are growing India. Together with now for Indonesia, competitive exports, they are growing Indonesia. So for foreign direct investments, they are also they were used to grow the Asian tigers and grow China. For competitive exports, same thing. So because of this, we are noticing this same trend recurring within these new Asian tigers. And right now, we believe because of this, they are forming and shaping the next growth stories of Southeast Asia and the world. So I'll cover now the third country, which is Malaysia. So for Malaysia, when I was doing up this slide, I was thinking of how to be able to illustrate it and to make it easier to understand and also have a catchy title. So that's where I thought of boleh when I was in an overseas trip in Malaysia. And I was thinking, I heard a lot of the words boleh, boleh. Then I was thinking, why not I just name the slide as Malaysia boleh? And indeed, Malaysia is boleh this year, especially. They have achieved more than 5% in terms of GDP growth for the past few years. All these have expected analyst expectations. And all these are also increasing the possibility of Malaysia exceeding 5% in GDP growth for the whole year in 2024. And for Malaysia, there's also another fundamental driver. So for PM Anwar, he has been consistently positioning Malaysia well as a politically neutral tech hub. So politically neutral tech hub. So all this helps it straddle between the US-China tensions and at the same time attract investments from both US and also Chinese tech giants in the fields of data centers, cloud, and also AI technologies. So some key names would be, for example, from the US tech giant side, you will see NVIDIA, which has invested together with, partnered with OITL Power to develop and AI development project, which is more than $4 billion US. And for Chinese tech giants, one key name would be ByteDance, that owns actually TikTok. They are going to invest into a $2 billion US AI hub within Malaysia. So like how President Jokowi transformed Indonesia back in the past 10 years from 2014 to 2024, we are witnessing how PM Anwar is actually slowly and gradually transforming Malaysia. And for Malaysia, it is actually an interesting story. So actually, a normal investor, including myself, if we invested in Malaysia in the past 5 years, you'll notice that actually, especially if we were to invest in Bursa Malaysia in the past 5 years, we would have actually lost 0.3%. So if you invested in the Malaysian market, the Malaysian benchmark, in the past 5 years, in USD terms, you would have lost 0.3%. And during this period, there were 3 prime ministers that were changed within Malaysia. But fast forward to this year, if you were to invest in Bursa Malaysia, just in the first 10 months in USD terms, you would have gained 22%. So this 22% already outperformed the MSCI Emerging Markets Index and also MSCI Emerging Markets Asia Index. So with the political landscape being more stable now, the PM actually needs a stronger economy before he gets to fight for re-election in the upcoming years. So all these are helping this unravel and unfold equities turnaround story within Malaysia, together with a longer-term structural growth story for Malaysia. So these are the points I wish I covered about Malaysia. And for the final country, Indonesia, but final country, Thailand. So Thailand is the ASEAN's second largest economy. Fundamental driver of its economy will be tourism, and this started with its first Amazing Thailand campaign in the late 1990s. And this year, Thailand is already witnessing a strong rebound within tourist arrivals, which is expected to hit 37 million in terms of tourist arrivals for the whole year. So all these are very near its peak of 40 million arrivals, which was 5 years ago, pre-COVID. And this year, the Thai government has also been implementing a lot of pro-tourist measures. For example, like visa-free entry from 93 countries, the new destination Thailand visa, together with extending the postgrad international student stay. So all these have been driving a lot of momentum in tourism activities, together with increasing tourist consumption. So increasing tourist consumption is important because all these help to increase tourism tax revenue. And when tax revenue is increased, there is actually more to redistribute to the domestic population. So all these are actually related and intercorrelated. So for example, in the earlier part of this year, in April, Thailand already announced a digital wallet policy to increase jobs and stimulate the economy. So this flagship scheme actually is going to give 10,000 Thai baht to 45 million Thais. So actually, you think of this as a larger scale of the assurance package we have within our own country. So giving 10,000 baht to 45 million Thais by September 2026. So on the first phase, this already happened in September, where they are giving out 10,000 baht to 14.5 million Thais. So phase 2, phase 3 are about to happen in the next 1 to 2 years, and all these are expected to drive further domestic consumption by redistributing tax revenue gains to increase domestic consumption. So you see these two are actually interlinked. The pro-tourism measures actually increase tourist consumption. All these increase tax revenue. And the tax revenue, which is then increased, is actually further passed on to the domestic population. So all these have a multiplier effect within the economy to further bring forward and also increase consumption within the entire Thai economy. And we believe all these are expected to increase earnings for the Thai listed companies within the next 1 to 2 years. And in the longer term, we believe that Thailand is already looking to pass a draft casino bill by next year. And once this is passed, Thailand's first legal casino is expected to open by 2029. So this will be faster than MGM Osaka in 2030. So you can think of this as like a new Bermuda Bay Sands, but in Thailand. So we have seen how the legal casinos have brought benefits to Singapore's economy. So all these are actually gradually reshaping and also thriving the Thai economy. And all these are also expected to attract more than USD 10 billion in foreign direct investments for Thailand to increase jobs. So all these are helping Thailand build its deepen its advantage within Asian tourism and also drive long-term consumption and growth within the economy. So in short, I've covered 4 countries: India, Malaysia, Indonesia, and Thailand. And in short, what you get for this ETF is actually a 4-in-1 opportunity to assess the gems of emerging Asia. So this is what the Lion China Merchants Emerging Asia Select Index ETF is all about. It is the world's first emerging Asia ETF traded in Singapore dollars. It's a collaboration between us and China Merchants Fund Management as part of our overall involvement within the Shanghai Singapore ETF product link. So this is a government-to-government initiative between the mainland Chinese and Singapore governments to help promote capital markets in the both of the countries. And this ETF, which tracks the IH Emerging Asia Select 50 Index. So the index provider is SGX Index Edge. So they are part of the entire SGX group. So this ETF also aims to track and consists of the 50 largest and most tradable companies by free float market cap after adjusting for foreign ownership limits. So the companies are domiciled in these 4 countries: Indonesia, Malaysia, India, and also Thailand, and also are listed in the respective domestic exchanges of these countries, together with the US exchanges. So this is where actually the Indian ADRs or Indonesian ADRs get captured within the index, because some might choose to actually list outside the domestic market to raise capital from foreign investors. So in terms of a few steps within the methodology, within the index universe, there are actually liquidity filters such as the daily traded velocity thresholds together with foreign ownership limits to adjust the free float to ensure the index universe actually consists of the relevant companies. And next step would actually be on the index weighting stage, where there are actually 3 weightage caps to take note of: 7% single stock weightage cap, 40% sector weightage cap, and the 50% country weightage cap. So in the end, what you get is a portfolio of 50 constituents, weighted based on free float market cap, and semi-annually rebalanced in March and also in September. And these are the 3 key features of this ETF, which is nicely summarized into GDP, which stands for grow and diversify your portfolio. So in terms of grow, riding on the growth of India, Malaysia, Indonesia, and Thailand. In terms of diversifying across stocks, sectors, and countries based on the respective weightage caps. In terms of portfolio, building a portfolio of the 50 largest and most tradable large cap companies within the IMIT countries. So the index was already launched back in 19th of July, and since inception of this index, all these are based on live performance. The index has outperformed the MSCI Emerging Markets Index and also the MSCI Emerging Markets Asia Index as of the end of October. And these are the key characteristics of this ETF. In terms of sector breakdown, you will see a high weightage towards financials, which is actually a signature characteristic for a lot of Asian economies, because financial institutions are a key capital provider for a lot of businesses within the country. And a lot of the businesses, usually to further grow, they need economies of scale together with a lot of capital. So because of all these, the financial institutions, which are the capital providers, tend to be a bigger part of the respective benchmarks and also the respective economies. And at the same time, you also see technology, which are the more forward-looking growth driving parts, together with other sectors such as energy, utilities. In terms of country breakdown, you will notice there's India, which is around 33.5%. So this part about India is a bit different compared to the other ETFs you see on the SGX, because this is India onshore. So we spend actually 3 to 4 months opening the accounts within India onshore. This will include actually for example, like exchanges like the Bombay Stock Exchange, India onshore, investing in the Indian onshore companies. So these are different from a lot of the other SGX ETFs that actually get exposure more on the Indian ADRs. So, and because there's actually it's actually on India onshore. So because of this, the trading hours are more in Asian hours, which is quite similar to the Singaporean trading hours because all are within Asia compared to the US part. So all these could be important to help optimize tracking error. So there are also other elements such as the Indonesian constituents, which are at around 22%. Malaysia is at around 14%. Thailand constituents at around 16%. And also the US component consists of a lot of Indian ADRs. So there are those Indian large cap companies that might not choose to just list within India. They might want to list outside India, or same for Indonesian ADRs. So because of this, that's why there's this US element to be able to capture these representative constituents of the respective economies. So what you get is a portfolio diversified across stocks, across countries, and also across sectors. So you notice these are the top 20 constituents. BCA, for example, is Indonesia's largest bank. You'll notice Reliance Industries, which is actually India's largest private taxpayer, together with largest public company by market cap and by revenue. So I'll briefly go through a bit about Reliance Industries because India has the largest weightage, and also Reliance Industries is the largest public company. So all these actually provides greater representation of this index and also the ETF. So Reliance Industries is the first company in India that has achieved a lot of I would say all-time or record high milestones in terms of profit, in terms of market cap, and also in terms of revenue. So all these are important because they are an influential company within the entire Indian economy. So I've mentioned they are largest taxpayer, largest public company. They have businesses across energy, across retail, across entertainment, media, across many, many different verticals. And it has been on the Fortune 500 list for more than 21 years. So all these are all about his historical achievements. So he has achieved a lot since its inception in 1958, which was for more than 60 plus years ago. But for Reliance Industries, perhaps actually another way to take note is actually more on the future of this company, together with how it would drive India. So in the recent fireside chat between Mukesh Ambani, who is the chairman of Reliance Industries, together with Jensen Huang, who is the CEO of NVIDIA, on the 24th of October. So I highlighted this date, 24th of October, because this date was actually 2 weeks before the US presidential elections. So when they actually came together, they reviewed a partnership to build an AI computing infrastructure within India. So these two heavyweights within the industry came together to unveil this partnership. And specifically, Jensen Huang mentioned during this fireside chat that India is going to be the country that will be exporting AI in future. So he specifically mentioned India is going to be the country that will export AI in future. So how many countries in the world actually can do this? And India can do this because they have the technology, on the AI technology, they will have the data, they will have the infrastructure, and most importantly, they have a large population of users because they are the world's largest population and they have the world's largest working age population. So Reliance Industries has achieved a lot throughout its history. They are now at its next stage of growth to be able to fuel the growth of India into a greater global giant. So because of this, that's why I picked Reliance Industries to talk about this Indian growth story, which we believe they will be rising further up, especially through the other features and also these factors, especially on this AI vertical. So because of this, we believe India will be a long-term structural growth story, together with the other Asian tigers like Indonesia, Malaysia, and Thailand, which we have mentioned earlier. So to conclude and summarize, the Lion China Merchants Emerging Asia Select Index ETF offers you diversified exposure to the 50 largest and most tradable large cap companies domiciled within India, Malaysia, Indonesia, and Thailand. So this ETF initial offer period is happening from 25th of November to 6th of December, which is this Friday, and the target listing date will be happening next week on 11 December. So the subscriptions will be collected within using US dollars, and after listing, the trading of this ETF will happen in Singapore dollars. So the trading ticker will be EAA, and we hope you invest in EAA and also use this opportunity to invest in emerging Asia. So thank you everyone for being a great audience. I'll hand over time back to Cindy in case you have more queries or questions from the audience to raise.
Okay, thank you. Thank you. I'm sure our users have tuned in, must have learned a lot from your sharing. So we actually have two questions from the floor. So the first question is that, is there any consideration for Vietnam? So I think the question is more of asking, like, compared to other IMIT economies, what does the IMIT economies have in advantage over Vietnam that make them in consideration for this ETF?
So in terms of Vietnam, there's a key consideration that is a bit different from these four countries, because Vietnam has actually a very tight foreign ownership limit. Vietnam actually has a very tight foreign ownership limit. So if you were to construct an ETF so because of this tight foreign ownership limit, and if we were to mix it with other, I would say, different markets like India and also Malaysia, Thailand, and also Indonesia, all these could actually cause Vietnam to be underrepresented. And because of all the technicalities behind it, there's also pre-funding involved together with the different currency settlement cycle differences. I mean, all these are, I would say, due to the infrastructural limits. So because of this, that's why we decided not to include Vietnam within this index. So all these are due to the reasons. And in terms of the broader reasons other than the infrastructural reasons, we believe that actually comparatively in India, Malaysia, Indonesia, and also Thailand, they have I would say a longer runway and also a longer structural growth story within their respective countries and also elements. So for example, India, I mean, the clear advantage is the demographic advantage and demographic benefit, whose largest population, largest working age population. I mean, this is the key point. And for Indonesia, the key point would be more on nickel production is already the world's largest, and all these are making it more and more competitive in terms of the exports, especially due to its resource-rich regions. For Thailand, the clear advantage is on tourism. They have a short to medium stimulus together with a longer-term growth to further stimulate and drive the economy. And for Malaysia, it is at a stage where the entry point is pretty attractive and unraveling a longer-term structural growth story, which has already proven itself through the past few quarters of GDP growth. So all these actually are presenting a more compelling, a stronger growth story compared to Vietnam. So because of this, that's why in the end, we decided to use these four countries to represent them as the Asian Tigers 2.0 for this ETF.
Understand. Thank you for such a comprehensive answer. Actually, we have another question from the same subscriber. So his question is actually, in the environment of interest rate cuts, is there a risk for high allocation to finance? Because based on the sector breakdown, almost 40% is actually allocated to the finance industry.
So actually, for the financial industry, I would say actually these interest rate cuts could actually benefit these financials. So okay, when interest rates were high, I mean, the net interest margins of these financial institutions, they have been readily increasing. All these have been good for them. But the financial institutions, they are actually also very sophisticated in managing all these interest rate risks. So because of this, a lot of them actually have been I would say, in protecting and hedging the interest rate risk through by allowing longer term liabilities, longer term assets to mitigate against this fall within short-term rates. So this is one thing. Second, also the reduction within interest rates actually drive more activities within investment and wealth management. So for the investment and wealth management arms of these financial institutions, they actually benefit from increased flows, increased assets for under management for them to further grow. So for example, key example actually would be for HDFC Bank or also for some of the other Indian banks where actually this flow of increased flow has actually led to further increases in fee income. So all these have actually benefited a lot of Indian financials and also Indonesian financials to be able to further grow. So because of this, that's why the in within the ETF, actually for the financials in terms of the exposure, all these are actually relatively well justified because they get to benefit from this reduction from interest rates. And for and on the I would say a broader front, on the broader front, for the reduction in interest rates actually also benefits a lot of the other non-financial companies. For example, like utilities or energy, because they are able to get cheaper financing to further expand their businesses. So all these actually benefit a lot of all these companies to get with financials to further drive and also support the growth momentum of the ETF constituents.
Oh, understand. Okay. I think there's a few more questions that's mostly on the like how to subscribe. So do look out for an email that we'll send after this webinar that will briefly let you know what is the how to subscribe to this ETF, as well as let's say if you want to replay any parts of this webinar, you'll also be available through a replay link so you can watch again. But some of the questions will be what's the initial sales charge? For that is actually there's zero subscription fee to subscribe to this ETF. And you can actually go to your portfolio in your Tiger Trade app, click on more, go to IPO, and then click on SG. You'll be able to see this fund that's currently available to be subscribed. So the minimum lot now is actually $1,000. Minimum quantity is 1,000 quantity, and each unit is actually $1. So the minimum charge is actually 1,000. Yeah. Okay, I think let's have the last question before we end off today's webinar. The question is actually, what's the biggest risk that you see for this ETF? And how is it being managed?
Okay, I think in terms of the biggest risk for this ETF, if you ask me, I think would be because right now, okay, okay, if you ask me on the broader front, it would be probably more on if there are like future hikes within interest rates. Because when there's hike within interest rates, actually US dollar will appreciate. And actually all these would cause actually some of the they would because when US dollar appreciate, actually all these might adversely impact some of the other emerging Asian and also normal emerging markets. Because there's all these rate hikes that are happening, because US is the global reserve currency when they increase interest rates, but the other emerging markets in terms of the respective central banks, they cannot so readily or easily increase interest rates. So because of this, they might be actually getting higher financing costs, and all these actually will be passed on to the respective constituents or even companies. But there are actually some mitigants for through these ETF. First, I think in terms of interest rate hikes, they are not really so likely now because we have seen inflation trending downwards for many quarters within the US. So because of this, interest rate cuts are the more likely scenario that will happen. And all these are actually expected to further drive some growth within the US market. And when US grows, actually the other emerging Asian markets also grow because US is still the world's largest economy. And also second, even if there are rate hikes happening, a lot of these companies, they are actually large cap companies. They have proper cash reserve in sufficient cash. So because of this, they might not need to take so much financing if interest rates are high. So because of this, actually all these are key mitigants. And that's why actually when we pick in terms of exposure for emerging Asia, we pick those which are large cap companies to be able to provide this kind of clean exposure. for investors, because when it's large cap companies, they tend to be less volatile compared to the small mid caps, and also at the same time they have larger economies of scale to be able to benefit and also further drive the respective countries' economic growth.
Understand. Okay, I think that's all for today. We have a lovely evening with Shin Xiang sharing more about the ETF, and I hope we managed to answer most of your questions. So do look out for the email again with more information on how to subscribe to this ETF. And thank you for your time today. Have a lovely evening. Thank you.
Okay, thank you, Cindy, and thank you, everyone. Wish you a great evening and great week. Bye-bye.
Bye bye.
Bye-bye.